Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. I'm Ruchira and with me is our CEO Dhirendra Kumar. Welcome Dhirendra.
Thank you.
Now, this one's a classic debate. Many investors now, they say, why bother with active funds at all? Because index funds, they are cheaper, they're simpler, and they often outperform as well. So, should everyone just switch to passive funds now?
It's a fair question. If you want to keep it low cost, if you want a broad exposure to the market, and you don't want to delve deeper into trying to find out which fund, which not, go for it. But it'll be worthwhile to explore further, delve deeper.
Okay. So today's conversation, let's begin it with two people. One who's already invested in active funds for a couple of years, and then another one who's just starting out. Should they both move to index funds the same way?
There could be a role for index funds in both their portfolio. But first one has to look at how. If you're a new investor, want to keep it simple, keep it low cost, go for an index fund. That cuts the delay of investing or getting started. Second is that if you can find a good fund, you're visiting Value Research online, you know that, okay, here is a diversified equity fund over a period of time. It holds the promise of beating the index and it has a process. There is a basis to it. Go for it. I don't think it is either or. And for many investors who are already invested, they should set up their portfolio on Value Research online. They should look at what is their large cap exposure. Maybe their large cap exposure, if it is 60, 70, 80%, then maybe substitute it with an index fund. You will keep it really simple. It will be low cost because I think the mid cap and the small cap universe, if you look at how SEBI has gone about classifying the stock universe, top 100 stocks, large cap, next 200, mid cap, and subsequent, the large universe of thousands of companies, they are small cap. I think the India story, if it pans out, there will be great opportunity. The difference between a great fund manager and an average fund manager or an index fund manager will lie in that small cap and mid cap universe. We have seen that over 10-year, 15-year, 20-year period, many such exposures has translated into index beating performance over such large period. And that is what you need when you are investing for a very long time. But for the large cap universe, I would say that you are not going to miss out something very significant. There are very few funds which are able to beat the index in the large cap category. Most of them struggle to beat it or match it.
Now, when it comes to active funds, investors, they often believe that they can pick the next star fund manager. How realistic is that expectation for a retail investor?
That is a wrong expectation. You should not choose a star fund manager. You should choose a consistent manager who is able to spell out what he does. Because there are star fund managers over 15-year period. They have had long patches of lean period. That does not make them a bad fund. Sometimes it could be a test of patience. You can be patient with those funds only if you understand what is going on. When those funds reward, they reward very handsomely. It could be a test of patience and how do you stick around. And that will require understanding. So active fund management or investing in actively managed fund is a tricky thing. You need to find a fund which is following a process. And that process you have to trust so much that even if you face a phase of underperformance or not so great performance or not so good performance compared to other funds, you should be able to stick around. And that I think is very crucial. That is why I feel that investing in actively managed fund is a fairly evolved exercise. And this is where you need some great information or advisor who could be very helpful.
Right. What about the argument that index investing, it's popular in the US, it works abroad, but India is still an active fund market?
That is reasonably true. When you look at the underperformance of large cap funds over a long period of time, or majority of the large cap funds struggle, that is a comparable situation with the US market or the developed market. But when it comes to the large universe that we have, and even in the US, there are managers who are able to consistently or do exceptionally well. But exceptional performance always comes with a big drawdown as well. And it requires understanding. There are funds who have done exceptionally well over a 5-year, 10-year, 15-year, 20-year period, and majority of mutual fund in the public domain are investing, they are unable to beat the benchmark. And that could be a struggle for individual investors. My understanding of the US market is that it's a very efficient market. It's a heavily institutionalized market. Large amount of pension money flows into index funds. And that is by design. That's the default investment happening. So that is driving the index fund. And index also has a problem. The index has a problem that it is a capitalization weighted index, most of the large cap index. And it is a self-fulfilling prophecy. What happens is when you put more money in the index stocks go up, and index stocks go up, and that is why you invest more money. And if this gets disrupted at some point, we could be in for a disappointment, because right now we are finding a situation that substantial part of the capitalization of the overseas developed market is dominated by index fund, and where nobody's thinking. That debate has already started. And in India, I think we are a little away from that debate, because we still have the large cap, beyond large cap, the mid cap, the small cap universe, which is very broad. And we are an evolving market. We have many companies which are still emerging. We are an emerging market. Globally, we are being referred by the developed market managers. We are being referred as the emerging market. And there are sectors, there are businesses which are still emerging. And we have a great part of our economy which is not still in the listed public domain. We still have good part of our businesses which are substantially government owned. They are not privately managed. So how our market, the complexion of the market, the dynamics of the market is entirely a function of who owns all those companies, who owns all those assets, and are they available to individual investors. And so I think we are sometime away from the dominance of index fund across our market, but large caps, it has started happening. And the biggest turning point, it was visible very much in India, that the index fund's performance or the index fund dominance in the large cap segment started with EPFO money and NPS money flowing into that, and that overnight became the largest Indian equity fund. So if we have that steady flow of money flowing into the index fund, then I think large caps are not going to have a breathing time.
Right. Can you suggest a middle path somehow, something that combines smartly both index investing and active investing? A structured portfolio.
Oh, the ideal way is the middle path, because forget about this large cap, mid cap, small cap, sectoral fund, thematic fund, active fund, passive fund. Forget about that. The goal of an investor is to invest his long-term money into equities. Now, all these funds will get you that exposure. Now, you need to diversify well, which means you should be invested in large cap, you should be invested in mid cap, you should be invested in small cap. Small caps are very volatile. So it should be a small part of it, otherwise you'll be scared out. If you are relatively new and you are already scared, you should not invest in small cap. If you are investing in large cap, it is expected to be little less, it is expected to be more steadier. Now you have to find the best way of participating. You don't invest in equity to beat the benchmark. You invest in equity to generate superior return for yourself. And if you are investing in index or actively managed fund, in fact, actively managed funds too, substantial amount of money is invested in the same large caps. It is no different. It is just that we are not here to beat the index. We are here to beat the inflation. We are here to generate enough return that satisfies us. We are here to generate enough return which does not disappoint us. Defeating the index is not my goal. And that is possible only in the long run, which is 5 years, 10 years time period. Short-term money you should not invest. Now comes how to go about doing it. Index funds are showing great promise in the large cap universe, and that should be a substantial part of your portfolio. Whether it should be 70%, whether it should be 40% depends on your preferences. If you are a venture person, you should have 40-50% into large cap, no more. Or maybe less, 30%. If you are not venturesome, then make sure that you have 70% of your allocation to large cap, that is fine. Remaining 20-30% or 50-60% depending on your appetite for or your ability to withstand the madness of the small cap and mid cap as and when it happens, then make sure that you have good actively managed funds there, and you have this large cap fund, equity index, the index fund dominating your large cap exposure. So with 3 funds, you can well achieve that. 2 actively managed, 1 index fund. And when choosing an index fund, make sure that you just have the lowest cost ones.
So there you have it. You don't have to really take sides. You just need to choose smartly and make your portfolio. Well, thank you, Dhirendra.
Thank you.
Thank you for watching. We'll see you next week again with another episode. Take care. Bye for now.